The story of how Uber makes money is not just about a ride-hailing app. It's about how a technology platform transformed an entire global industry. Founded in 2009 by Travis Kalanick and Garrett Camp, the original idea was simple. Press a button on your phone and get a ride. However, behind that simple user experience lies a sophisticated marketplace model. Multiple revenue streams, dynamic pricing, data optimization, and expansion strategies define Uber's business. To understand how Uber makes money, we examine its platform operations, how it earns from drivers and riders, expands into food delivery, and balances growth with profitability. At its core, Uber operates as a two-sided marketplace platform. It does not own most cars or directly employ most drivers as traditional employees. Instead, Uber connects independent drivers with riders through its mobile application. This asset-light model is crucial to understanding its revenue structure. Uber avoids traditional transportation costs like maintenance, fuel, and depreciation. Drivers bear those expenses. Uber facilitates transactions, provides tech, manages payments, and optimizes matching. Multiply that small percentage across millions of rides daily worldwide, and the revenue becomes substantial. One important element in Uber's pricing strategy is dynamic pricing or surge pricing. Surge pricing activates when demand for rides exceeds the available supply of drivers. During peak times, heavy rain, rush hour, or major events, fares automatically increase. This incentivizes more drivers to go online and balances supply and demand. Surge pricing significantly increases Uber's commission per ride. Although criticized, it remains a key revenue optimization tool. Beyond standard ride services, Uber introduced premium categories like Uber Black and Uber Comfort. These services charge higher fares for luxurious vehicles or enhanced experiences. Higher fares mean Uber's percentage commission yields more revenue per ride. This tiered pricing strategy captures different market segments. Diversification of ride categories strengthens the platform's overall revenue base. Another major revenue stream is Uber Eats, Uber's food delivery division. Originally Uber Fresh, it became one of the company's most significant growth engines. Uber acts as an intermediary between restaurants, customers, and delivery drivers. Uber earns money from three sides: restaurant commission, delivery fees, and service fees. This multi-layer monetization makes Uber Eats particularly powerful. Food delivery often generates income from both restaurants and customers simultaneously. The COVID-19 pandemic dramatically accelerated Uber Eats' importance. As ride demand declined during lockdowns, food delivery surged. This demonstrated Uber's strategic advantage in operating multiple platform-based services. Its vast driver network and logistics infrastructure allowed quick reallocation to delivery. Uber has also expanded into freight logistics through Uber Freight. This division connects trucking companies with shippers who need to move goods. Like its ride-hailing model, Uber Freight earns revenue by taking a percentage of each transaction. This move reflects Uber's ambition to become a transportation and logistics technology platform. By applying its marketplace algorithm to freight, Uber taps into a trillion-dollar global trucking industry. Advertising has become another emerging revenue source. Uber collects vast amounts of data about consumer behavior. This data enables targeted advertising opportunities within the Uber app. Restaurants can pay for promoted placements on Uber Eats, and brands can advertise to users. As digital advertising becomes increasingly valuable, Uber's user base represents a monetizable asset. Subscription models also contribute to recurring revenue. Uber introduced membership programs like Uber One, offering discounted rides and free delivery. Subscription revenue provides predictable cash flow and increases customer retention. Subscribers are more likely to use Uber frequently, maximizing their membership value. Despite massive revenue streams, Uber has historically struggled with profitability. The company spent heavily on expansion, marketing, driver bonuses, and technology development. For years after going public in 2019, Uber reported significant losses. However, these losses were partly strategic, focused on market dominance. By entering cities aggressively and subsidizing rides, Uber aimed to build network effects. Network effects occur when a platform becomes more valuable as more users join. More riders attract more drivers, and more drivers reduce wait times, attracting more riders. Once dominance is established, the company can gradually improve margins. Competition has also influenced Uber's pricing and profitability. In many markets, Uber competes with companies like Lyft. Competition forces promotions and competitive pricing, compressing margins. However, in markets where Uber achieves strong market share, it benefits from scale advantages. International expansion plays a major role in Uber's revenue strategy. Uber operates in dozens of countries, adapting its model to local regulations and cultures. Global diversification spreads risk and increases total ride volume. However, international operations also bring regulatory challenges. Governments debate if Uber drivers are independent contractors or employees. If reclassified as employees, Uber would face higher labor costs, affecting profitability. Data and algorithm optimization are central to Uber's efficiency. Sophisticated algorithms predict demand, match riders and drivers efficiently, and optimize routes. Efficient matching reduces idle time for drivers and improves customer satisfaction. Higher efficiency translates to more completed rides per hour, increasing total commission revenue. Technology is not just a tool for convenience, it is the backbone of Uber's revenue maximization. Uber's financial reports show revenue divided into mobility, delivery, and freight segments. Mobility remains a primary driver, but delivery has grown significantly. This diversification reduces dependency on a single income stream. This multi-segment structure reflects Uber's evolution from a ride-sharing startup to a global logistics platform. Another critical factor is pricing flexibility. Uber can adjust fares dynamically in response to fuel costs, taxes, regulations, or competition. Unlike traditional taxi companies, Uber can optimize pricing continuously. Marketing strategies also influence revenue. Uber often uses promotional discounts to attract new users. While discounts reduce short-term margins, they increase user acquisition. Once users become habitual customers, Uber can reduce incentives. Customer lifetime value often exceeds the initial cost of acquisition. Corporate partnerships add another layer of income. Uber partners with businesses for employee travel, airport rides, and delivery collaborations. These agreements generate consistent ride volume and strengthen brand presence. Looking ahead, Uber's future revenue growth may depend on automation and electric vehicles. Autonomous vehicle technology could reduce reliance on human drivers, lowering labor expenses. Although this transition faces hurdles, it represents a long-term margin improvement opportunity. Partnerships in electric mobility could reduce environmental impact and attract sustainability-focused customers. In conclusion, Uber makes money primarily through commissions on rides and deliveries. Supported by surge pricing, premium services, freight logistics, advertising, subscriptions, and strategic partnerships. Its asset-light platform model allows scalability across cities and countries. While profitability has been challenged, Uber's diversified revenue streams and tech infrastructure position it as a dominant player. The company's success lies in its ability to connect supply and demand efficiently through technology. Uber's business model demonstrates how digital platforms can disrupt traditional industries, leverage network effects, and create multiple monetization layers from a single app interface.